Everyone, and thank you for your patience. Today's webinar is 10 tangible takeaways, how to build and manage a best-in-class digital asset accounting environment. And before we get started, there are a few housekeeping items I want to go over. So just want to address the webinar pane. You can maximize or minimize the webinar pane during the presentation by using the red and orange arrow buttons. During the webinar, we also encourage you to ask questions, and in the webinar pane, you can see a questions box where you can type in your question and click submit, and then our presenters will be addressing those questions throughout the presentation and at the end as time allows. I also want to make sure everyone has good audio, so if you're using a telephone, please click on the phone call audio option, and if you're using a computer, please select the computer audio option. And if you're joining us today for CPE, just a few reminders: you need to be on a personal computer, no smartphones, logged in through your unique URL. You have to be logged on to our online software for at least 50 consecutive minutes, and make sure you also respond to at least 75% of the polling questions. Today we're going to have 4 polling questions, so make sure you answer at least 3, and also complete the evaluation survey at the end of the webinar. And just also as a note, everyone will receive a link within 48 hours of the presentation to a recording of today's presentation as well as a PDF of today's slides. And I just want to go over today's learning objectives. Today we're going to evaluate best practices for accounting and auditing cryptocurrencies and digital assets, review and debunk common accounting misconceptions and questions, and discuss tangible takeaways to help you navigate accounting, audit, tax, and risk issues common to fast-growing companies. And with that, I'm going to go ahead and pass it off to Andres.
Hey, thank you. Good morning, everyone. This is Andres. Apologies for us starting a few minutes late. It's actually my fault or my responsibility. The reason is, and this is what happens when you do live webinars, out of all the days to have a minor traffic accident, today I had one, and everyone's fine, luckily, but the person behind me was unfortunately texting or looking at their screen and driving. So may this be a lesson for all of you listening and for myself. It's just not a good way to be handling your car. So anyway, that's why we started a few minutes late here. But we are super excited to kick off this webinar. This is the first blockchain specific webinar that we're organizing. I've done a number of webinars over the years here at Armanino, but this is the first one that is only about blockchains and crypto, and so super excited to be hosting it today. We've been working pretty hard on some of the content that we'll talk about in the last few months, and Jeremy now, who's part of my blockchain team, has really been able to dig into some of these topics, and it's just been a lot of fun. But we also have 2 non-blockchain team people that are joining us today, and that's because we're going to talk a little bit about audit and how audit relates to blockchain. And so we got Heather Moore, who's a partner on the audit side and has worked on a number of crypto clients for a number of years, as well as Heinrich, who has also worked on a number of high-profile crypto clients on the audit side of things. So there's really 3 major themes that we'll be handling today. All right, let me just get the clicker going. There we go. And so there's 10 takeaways that we will leave you with, but you can categorize them in 3 major themes. The first one is around accounting solutions, and we'll spend a good amount of time digging into what some different accounting solutions are if you're transacting in cryptos, if you are running a crypto startup environment, if really cryptocurrencies are touching your income statement, your balance sheet. This portion will be super interesting to you. Second, we'll talk about audit, and what we found is that there's actually quite a bit of misconceptions around how to audit digital assets and what's possible, what's not possible. And there's some really basic and easy tricks and strategies that you can apply that even if you don't need an audit right now, you're going to really thank us in a few years if you take those steps right now, because it's just going to save you and your auditor a ton of work. So we'll focus on those quite a bit. And then finally, we'll give you some very practical IT considerations, data management considerations, really around, where should you be looking for price points, et cetera. So some very practical things to finish up with. But I thought a good place to start is actually to talk about some of the misconceptions that we've heard over the years and try to debunk those. And so the first one is, why should we even maintain books or invest in a crypto accounting program? Everything is on the blockchain. And there's a few reasons why this is not the right way of thinking about things. So first of all, if you're using centralized exchanges, then your transactions will usually be pooled with other transactions that exchange is executing. And so you actually would not be able to trace your specific transactions back on the blockchain. But even if you could do that, what you want to keep in mind is blockchains are synonymous, public blockchains are synonymous. And so, deriving the information out of a 42-character hexadecimal number with an associated unit account or an associated transaction number is a very, I would say, back of the envelope and just a hard way of doing things, and not the best approach. And blockchains, because of their nature, just don't track what the tax basis might be. They don't know how to code for transactions from an accounting standpoint. They don't know who your counterparties are. They don't classify revenue, gains, losses, purchases, etc. And so I would say this one is officially debunked. Moving on to number 2, audit preparation is easy. It's all on the blockchain. That's, I would say, to some extent true. Information is on the blockchain, but not necessarily your information. And so, of course, as auditors, we're only interested in what's relevant to your business and your financial statements. And so it's just a crazy amount of work if we got to start trying to pull it from a or multiple blockchains and kind of work our way back from there. However, I would say public blockchains are really good in facilitating some of the testing for financial statement assertions that auditors typically do. So think about testing for cutoff, testing for did a transaction truly occur in a certain fiscal year. Blockchains are amazing for that. Blockchains are amazing in making sure that transactions and associated amounts are accurate, and that they actually occurred, testing for existence. Blockchains are not very good to test for completeness of your data. So we wouldn't be able to see, just looking at a blockchain, whether we're including all of the transactions or not. They're not good for fair value determination. They're not great for testing for rights and obligations. So proving that you actually own something because of their synonymous nature. So number 2, officially debunked. Moving on to number 3, confirming ownership is unnecessary. All the activity is public. It's all on the blockchain. Well, so yes, the activity is public, but how do we know as auditors that it's really you who is executing these transactions and not some other company, some other person living down the street from you whose name might be Satoshi Nakamoto is the one who's executing these different transactions? We just don't know that. And so we've really thought about this over the years. We've really had to put this through quite a bit of thinking, rethinking, reevaluating. And Armanino has been fortunate enough that we started doing the audit work of this tiny little exchange back in 2015. At the time, that's called Coinbase, and of course became this massive account over the years, and became too big eventually for us to keep doing that work. But we worked on that account as auditors for many years, and so we really had to think this concept through. And so one way of testing that you truly control a private key, well, let me actually take a step back. So obviously we would never ask you to share your private keys. If you have the private key, if you know the private key, you basically have the asset, you control the asset. So that's absolutely not the right way to think about it. One way to potentially show that you control a wallet, that you control the private keys, would be that we ask you to move some funds around. And we say at a specific time, you're going to move some money from this wallet to this wallet. And so we know you have a private key, but that really interrupts with your business, and it's just not the right way an auditor should be approaching it. And so what we have done instead is we ask our clients to sign a digital or generate a digital signature. And the signature really is a hash. The hash doesn't reveal any of your private keys, but using the hash, we can verify that you must have used your private key to generate that hash. And it's a pretty cool process. We've gotten really good at it, really efficient at it over the years. I think we probably were the first CPA firm to follow this or build this methodology. I don't know if there's other firms right now who might be doing the same thing, but if your auditor's not sure on how to do this, you're not sure on how to do this, definitely give us a call. We're happy to get more folks within this ecosystem to follow the right procedures, do the right things, and share our knowledge. So this one officially debunked. The last misconception that I want to talk about for a minute is I'm not showing an auditor my private keys. Good luck auditing me. Well, I think, yeah, you should not show your private keys. That's absolutely right. But the signature process here allows us to get comfortable around control and ownership. So let's move on to some of the right strategies of doing things. So the first tangible takeaway, the first topic that we're going to talk about is we're going to talk about accounting systems and accounting infrastructures. And I would say the key thing on this slide is the very first bullet point or sub-bullet point, that investing in a crypto accounting solution just makes a ton of sense. And there's a number of reasons why you should consider that if you're touching crypto, if you're transacting crypto, for sure. If you have issued crypto, there's just a number of limitations that existing accounting solutions have. So, we see a lot of clients using QuickBooks Online or Xero or Excel or Intact or NetSuite. And inherently, those systems are just not properly set up to transact in a crypto environment. First issue is that transacting in crypto requires your accounting environment to track up to 18 decimals. And I don't think any of the accounting systems out there today are set up to, the traditional accounting systems out there today are set up to do that. Second, they don't know to track gas and mining fees. They're just not set up to be looking for that. And so there's a lot of back of the envelope manual work that you'll have to do if you want to properly account for those. And three, and this is really the biggest problem that we have with legacy accounting solutions, is that they don't run their own nodes. And the whole beauty of public blockchains is that the information is out in the public and anyone can run a node and download the entire blockchain history and rely on that information. And that's really the right way to think of blockchains and cryptocurrencies in general. And so the crypto-specific solutions, the crypto-specific accounting solutions in general do run their own nodes. What they also do, and this is pretty cool, is they've built APIs with exchanges, with wallets. And so they're not just pulling on-chain information through nodes, but they're pulling off-chain information and auto-populate really all the transactions that you're going through within your accounting software. So it just makes your life a whole lot easier and makes things a lot more efficient. There's about 5 systems that we reviewed, and so you see the logos here. So Balance, Blocks, Legible, Libra, and Soft Ledger. And we spent quite a bit of time demoing these softwares, getting them in sandbox environments, and really testing for about 50 variables, 50 features that we think are relevant within this new space. And before I dig into what the 50 are and what we think some of the key features are that you should be thinking of, want to really thank these 5 companies. We've just had a really great experience in working with all 5 of the management teams. They've been super helpful in just sharing information. And some of these are fairly young startups, and as a young startup, it can be a little intimidating to have somebody, really ask you to lift up the kimono and let us play around with everything. But kudos to all of these teams for just being really, really positive and open dialogue type of players in this ecosystem. What we're not going to do is go through a side-by-side comparison of here's what this solution does today, here's what it doesn't do today. We could have that conversation, but I think that would be more appropriate in an in-person type of conversation. A and B, all of these teams are in heavy build mode right now. So some of the features that we tested for that might not exist today, these teams are working on. And so more relevant, and given the time frame that we have, we thought it would be to talk about what are the key features that you should be looking for in evaluating these different solutions and when you're talking to these different teams. And so, first of all, at a high level, there's 2 different ways to approaching this crypto accounting environment. One is that you would still have call it legacy accounting solution. So you'd be using QuickBooks or Xero or Intact or anything else. And on top of that, you would use a crypto-specific accounting solution. And the crypto-specific accounting solution would plug in, and usually it's through download and uploading, but fairly smooth process. And a bunch of these are working on direct integrations. But the idea is that you plug in the crypto accounting solution into the rest of your ERP and your accounting environment. And for the crypto specific needs that I mentioned, these legacy systems don't have, you can rely on the crypto accounting solutions. The other approach is that some of these solutions offer more of a full suite solution themselves. And so they effectively replace QuickBooks, Xero, Intact, NetSuite, whatever it is that you're using, and have AP, inventory, AR, cash modules and functionalities built in themselves. There's a lot of information on this slide. I'll let you read through it yourself, but really what I think is critical here is that you think about what is my full accounting and ERP environment today, and to what extent are things plugged in between expense processing and invoicing and billing and maybe my HR modules, and if you're using a CRM solution or something, that might be tied in as well. And so if you have this entire environment that's already set up and it's working nicely, and you got NetSuite, Intact, QBO Xero working well, doing the things it needs to do, except for the crypto pieces, I would probably choose for a solution that plugs in and that supplements the rest of your environment. If you're building something and you're truly operating in a crypto native environment, and the crypto functionality is really the first thing that you're looking for, then I would say you may want to consider solutions that are more crypto native in nature. But to be honest with you, we see solutions on both sides working perfectly, either if you're super early stage or you're working already for a few years and have more of a setup environment. There's probably other features that are more relevant in making a decision between both. The last thing that I would say here is what's probably most important is that you not only consider what are my needs today, but try to think of what is the accounting environment that I need for this business to continue to scale. And when I compare it to the roadmap that I have in obtaining new customers and adding new lines of service, new products, how do I make sure that I'm setting up an accounting environment that anticipates that? So you don't get caught off guard and continuously have to transition to a new accounting environment, and you're always trying to play catch up. So I think that gets us to our first polling question. And question that we have here, do I click or we're good? Okay. So the question that I have here for everyone is really about the different accounting solutions that I just discussed. And so we're just curious what you folks on the call are using today and what you think would best fit your needs. And so there's the ready-made crypto subledger. So that's plugs into the rest of your environment. Second option is the standalone solution that would effectively replace QBO or Xero or Intact or NetSuite. Third is an internally developed system, and we've seen some of our clients use that as well. Fourth is probably, hopefully not the right solution, and that would be using Excel. And your fifth option is just using the legacy accounting solution, QBO, Xero, whatever it might be. So we'll give you a minute to respond to the right answer for you. All right, so how many folks? 77%. All right, we'll be closing that in just about 10 seconds here for those who have not voted. All right, let's close it up. And let's look at the results. So looks like we had a lot of people choosing for the subledger solution, which makes total sense. That's what we were hoping for. And then also a good amount of people saying, well, I actually would prefer a solution that entirely replaces the legacy accounting environment. And then we probably had some folks who develop their own stuff and some folks who just stick with the legacy systems. All right, thank you. Jeremy, turning it over to you.
Awesome. Thank you, Andres. Really appreciate the primer there. So we're going to dig a little bit deeper into crypto accounting solutions, but first let's think about what blockchains are great at. They're borderless, they're decentralized, they're uncensorable, all these great things that we know and love about blockchains, but an often overlooked inherent capability of blockchains is data availability. And Andres actually touched upon this during his first tangible takeaway. But the availability of having blockchains ready available for anyone with a little bit of technical expertise that can run their own node can pull all their data. And what's great about these crypto accounting solutions is that oftentimes they maintain their own nodes and can pull balance and transaction data at any given point in time, which is pretty sweet. But that's only half the equation. What they also allow having these solutions is allows to build exchange APIs. So you get similar transaction and balance data from exchanges as well. And typically what we see is that that covers basically the whole realm of potential blockchain transactions. But it's not all rainbows and sunshines. It's really hard to build and maintain these nodes, these explorers on top of the nodes, and also these API exchange integrations. So inherently what we've seen is some of these crypto accounting solutions have to make tough choices about what to support, which currencies to support, which blockchains, and which exchange integrations to build. So when we did our review of these crypto accounting solutions, we took a peek at what the most supported currencies were and other factors. So you might be surprised actually looking at this that Ethereum was the most supported blockchain. And if you think about it, it makes a lot of sense because oftentimes these crypto accounting solutions are targeting crypto projects, many of which had an ICO, and many ICOs are built on top of Ethereum. So that explains the Ethereum and ERC20 support. Not surprisingly, Bitcoin is heavily supported on all these exchanges. But one to keep in mind that I find interesting is the availability of NFT tracking on these crypto subledgers. Something that we think at Armanino is that asset tokenization is going to take off. And we think NFT support is going to be that function that allows tracking for those digital assets. And just as a caveat here, before I get too deep into this, understand when I say, let's say, Doge wasn't supported on your favorite crypto accounting solution, this doesn't mean you can't use that crypto accounting solution. It just means that they don't host the underlying node that will automatically pull balance and transaction data. You can still manually input. The only difference is that you'll have to manually input the transactions related to kind of those not as typical currencies. Then once we get into the exchange realm, you can see, Binance is the most supported, which makes a lot of sense. And then there's some of the usual suspects on some of the other platforms, Coinbase, Kraken, Poloniex, some of your other favorites.
And Jeremy, I remember this was an area where the teams were all working on trying to get more blockchain supported, trying to get more exchanges supported. So this is really a snapshot, folks, of where these solutions are today. I expect within the next 6 months, it's going to look fairly differently.
Yep, I'd say every team I've talked to is currently en route of building more API integrations for exchanges and maintaining more nodes. So that's great for all of us in the whole ecosystem as a whole. So it's good stuff. From our research right now, Legible and Blocks actually shine in this area where they host 8 or more blockchains and have 10 or more exchange integrations. Not too shabby. Thanks, guys. And that takes us to our tangible takeaway, number 3. And when evaluating these crypto accounting solutions, it's just important to understand that this industry is still super young. The crypto accounting solution that you might pick today might not fit all your needs right now, but it's important to think of the future. Hopefully right now, the current state of your favorites is serviceable, if not fulfilling all your needs right now. But you want to make sure that the long-term roadmap of these crypto accounting solutions aligns with your future needs of tokens and exchanges. I think if you get that covered, in the next 6 to 12 months, you'll probably have everything that you need in order to have a best of breed accounting environment. Mm-hmm. So that takes us to our next topic, which surrounds pricing. And pricing seems simple, but it's actually kind of more complicated when you get into the weeds of it. Pricing describes the process of, what you might think, applying a price at either the time of purchase or at a period end. And this seems simple, you might buy some Bitcoin on Coinbase and that's the price. But not all transactions are that simple. For example, think of a crypto to crypto transaction where you're buying Ethereum with Bitcoin and all of a sudden the transaction's denominated in Bitcoin and there's no US dollar figure really readily accessible as part of that transaction. And this kind of brings up one of the inherent problems with blockchains, which blockchains don't include all the data on-chain that we might need for transactions, pricing, maybe counterparties, coding, etc. And this, in the crypto world, is known as the Oracle problem. Basically that, like I just mentioned, all on-chain, all data is not available on-chain, so we must rely on third parties. And in this case, we're going to talk about what kind of parties provide pricing information. Just before we dive into the different types of price party feeds, we'll talk about it from an accounting perspective, understanding the importance of why pricing is important. Like I just mentioned, crypto to crypto transactions and developing a cost basis, you're going to need a third-party price feed for that. Also, if you're marking to market your assets on a periodic basis, and then tracking unrealized and realized gains and losses. You could, before we dive into this, you could do all this manually, but also the crypto accounting solutions many times do this automatically as well, using a variety of methods. So the first method that we'll talk about is using a single source of data for your price feed. What we see this mostly is using the spot rate at an exchange, Binance, Coinbase, pick your favorite. The pro here is that it's pretty darn easy just to pull one spot rate from one exchange. But the problem is that there's the potential for manipulation on certain exchanges. If I think about back in 2017, I think Tether exchanges had a premium on Bitcoin of over $200. And then in Korea, I think the Korean exchanges had a premium of sometimes $500 or more. So if you're relying on those exchanges to get your pricing data, you're going to have a lot different price. And then the problem now, or that we're seeing specifically, is that many of these exchanges don't have SOC reports at this point. And what that is, it's basically an attest report giving users assurance over the controls and processes at that exchange.
Well, I think, and a great example of that, Jeremy, is some of the news and stories that you're seeing coming out now on the Quadriga exchange in Canada and how poorly controls were managed there. They definitely did not get a SOC review done. It was just not, they would have never passed that. So I see the users here moving more towards, hey, we're looking for some kind of validation. We're looking for some quality control. And of course, Armanino is a firm that does that and issues these types of reports and engages with exchanges all the time. So that's probably a topic for another webinar, but yeah, we think SOC reports are really the gold standard in this new ecosystem.
And that's probably a good segue into giving Libra a little plug. Congratulations, you guys, on getting your SOC report, I think, in the last couple weeks. So setting this bar high there. Good work. The next type of third-party price feed that we see is using a price aggregator. And what an aggregator does is it compiles information from different sources into a single point that you can pull, making your life a whole lot easier. An example of these are Nomics and CoinMarketCap. We see these used in crypto accounting solutions and other ways or other exchanges to price their currencies. The pro here is that it's pretty easy. It's still a single point, so you only have to pull one number. The problem, though, is that it's centralized still, so you still have a single point of failure. And we don't see any SOC reports over these price aggregators as of yet. But on the upside, there is a potential for a SOC report. So Nomics, CoinMarketCap, feel free to come to us, and we can hopefully help you guys out.
There's a lot of plugging here for SOC reports. We may have to dial that back a little bit. That was not planned, by the way. But
yeah. Sorry if you guys are listening.
We're passionate about SOC reports.
Yeah. And then the third type of price feeds is compiling, with aggregating them yourselves. And what we see is that one of the crypto accounting solutions that we looked at actually takes 200 different sources and compiles them themselves and doesn't rely on a centralized party to compile that price to smooth out the volatility over the different sources. The problem here is that that's relatively difficult to do, but on the upside, you don't have to rely on a third party, which is great. So that takes us to our next tangible takeaway, which is a nice little summary for you guys. You can put it on your wall, you can frame it. If you ever need to know the pros and cons of different pricing sources, you can take a look here. That third column is supposed to be manual aggregation. Apologies for that not making it there. But it is important to think about, if you're using a crypto accounting solution, maybe what pricing aggregators or ways of compiling a price that they're using. We've seen price aggregators used for blocks, Legible, Soft Ledger, and Balance is the one that's using the manual compilation of over 200 sources. And then we see Libra actually doing customized pricing feeds that you get to pick your sources, which is pretty cool. And if you're actually doing your pricing manually on a month-to-month basis, our recommendation would probably be just to use an aggregator. It's the best combination of easiness, but also smooths out the volatility over different data sources. So that takes us to our next polling question, which Marie will be launching.
So the question here is, what type of price feed are you using to validate your crypto? Is it a single source? Is it an aggregator? Is it some manual aggregation that you're doing? Or is it something else? And we'll give you a good 30 seconds or so to respond to this question. So is it single source? Could be one or two, or it could be an exchange or something else. Are you using a price aggregator? Are you doing some manual aggregation work yourself? And looks like we got over 80% of responses in, so let's close it up. And you guys are doing well. We have a lot of people using a price aggregator, and we got about 30% of folks saying that they use single source, and then there is 18% of people who are doing manual aggregation, which, again, not necessarily wrong, but just will require a bit more work on your end. All right, let's keep moving.
Yeah, great. So that segues us into the next kind of topic, and that's understanding why pricing matters. Well, we talked about that pricing matters if you're applying a cost basis, especially with crypto to crypto transactions, but also tracking unrealized and realized gains. Well, why is that important? Well, you want to make sure that you have accurate financial statements, but you also need to fulfill the tax man. And as we all know in the crypto space, dealing with crypto taxes is really a special type of headache. UTXOs, HD wallets, public addresses, these don't fit very well in the IRS's definition of property. But on the upside, since the IRS does classify crypto assets as property, any consistent accounting method can work here. FIFO, weighted average, is what we've seen the most of. But there is a way to have more precise inventory tracking. And what it's called is specific ID, but it's not your standard specific ID. It's by UTXO. And UTXOs are unspent transaction outputs. And in crypto, there's two base models, which are the UTXO base model and the account base model. So to further explain UTXO, I think it'll be easier to describe the other model first in order to give some context. For account-based model cryptocurrencies like Ethereum or EOS, if I wanted to send Andres a transaction, if I wanted to send $7 of Ethereum, I would send him one chunk of $7 worth of Ethereum. The key there to understand that it's one input, it's one chunk. For UTXO-based currencies like Bitcoin or Litecoin or other Bitcoin derivatives, when I'm sending $7 worth of Bitcoin to Andres, there might be multiple inputs. There might be a $5 input and two $1 inputs, almost like cash. So the idea here is that you don't have a single unit, a single chunk. You have multiple chunks or multiple units going into one transaction. And what's really cool about UTXO-based cryptocurrencies is that you can actually track the basis and gains by individual UTXO chunk. So that takes us to our next tangible takeaway, which if you have UTXO-based currencies, we do recommend using this model because it is very precise. You can get the individual chunk basis and realized gains, which is pretty good. I have to give a shout out to the guys at Node 40. They were the first ones that actually brought this up to me, and I thought it was really fascinating. So I thought I'd share it with you guys too. And for the other account-based cryptocurrencies like Ethereum or EOS, FIFO by wallet is the most popular method of tracking that we've seen. So I just thought I'd share that as well. So that starts to touch on the accounting environment. And we do want to dive deeper on setting that up. But first, we have another polling question.
All right. Our next polling question is about tax treatment. And so we're going to ask you what cost method you are currently employing for your crypto holdings: FIFO, LIFO, weighted average, specific ID, or UTXO specific ID. And we'll give everyone a few seconds here to respond to this question. All right, looks like we've got a lot of people voted. All right, let's close it up. And perhaps as expected, 61% are going with FIFO right now. We've got 22% going with weighted average and 17% going with specific ID. So yeah, it's makes sense.
Yep, I'd say that's kind of what we've been consistent with what we've been seeing in the market.
Yep.
Great. So we can get into actually talking about your accounting environment and how you might set up your chart of accounts. Dealing with crypto, you have a lot of unique scenarios that you might not have had as your previous gig as a controller or an accounting manager. You have a bunch of different tokens to account for. You have different wallet structures. You might have hierarchical deterministic wallets. You might have individually derived, I like to call them JBOC wallets, or just a bunch of keys. And then you have, a bunch of different exchanges that you might use as your fiat on-ramps. And you might have different use cases for different currencies. And then you have special cases. You might have non-fungible tokens. You might have jointly owned wallets, which we've come across before, which is pretty interesting. So what is our recommendation about how to best organize your chart of accounts? Well, we recommend breaking them out as much as you operationally find efficient and can. And there's a few reasons for that, and we're going to dive into that. And that's going to take us to our next tangible takeaway. So the first reason why you're going to want to break out your chart of accounts as much as you really can, is because for gain loss tracking or cost basis tracking, think if you had multiple currencies in one account, like if you had Bitcoin and Ethereum in the same account and you wanted to market at the end of the month, all of a sudden you have to apply 2 different spot rates. And that's not that bad. It's just a little bit of a headache. But then when you start, maybe the other token that you have in that account doesn't have an active market, all of a sudden things start getting a little bit dicey. And that takes us to our next reason to break out your accounts, is that you can apply homogeneous application of accounting methods. Like I said, if you have an active market, you might treat a token with an inactive market a lot differently. I like to use the example of mana and your virtual plot of Decentraland, and you might treat the Decentraland plot of virtual land as real estate, but the mana used to buy the Decentraland plot as inventory. You're not going to want to have those in the same account, so it's probably a good idea to break those out. Next is auditability. Honestly, it can help us actually de-scope certain transactions or assets, especially if they're really low dollar amounts. If you combine anything or everything into one big account, we're going to have to get comfortable over everything in that account. So if you break things out, it actually helps us de-scope. It saves the auditor a headache, and it could actually end up saving you audit fees. And then next, we just find it's good for organizational hygiene. It's just a lot simpler to think of if you have one wallet, one account, one wallet, one crypto. It's just a lot easier. Once you start commingling, you have the headache of trying to code different currencies, try to transaction tag, and trying to reconcile accounts becomes a lot more difficult. So we've talked about setting up your accounting environment correctly here, and that's pretty important to an audit, but we want to dive into what an actual audit might entail. So that's when we're going to bring in our special guests. We're going to bring in Heather Moore, our crypto audit expert.
Thank you, Jeremy. Appreciate you having us here. So I just want to talk a little bit about understanding, are you ready for a financial statement audit? But really the question is, why does any of the stuff that we've been talking about here even matter, right? Like I'm putting my books together and everything's great. But the reality is that if you're not already required in the near or not too distant future, you're likely going to have an audit requirement or some type of compliance requirement. It can either come from your equity investors, debt holders, or regulators like state agencies for a money transmitter license, perhaps, or in federal agencies such as the SEC. Oftentimes we're finding companies in this space have a lot of audit requirements. And then lastly, management, the board could just require an audit to gain that extra level of assurance that the financial statements are properly being reported. So then the question is, are you ready for a financial statement? And the key here is to understand what kind of support you will need. What is the audit team going to be asking of you? So do you have all of the reconciliations clearly explaining the transactions, the balances as of the reporting date? Are all of the invoices and contracts clearly labeled, organized, filed for easy retention upon request? So you have this full audit trail to be able to explain those transactions to your audit team. And lastly, and most importantly, how are you documenting the policies and procedures you have in place, as well as the accounting considerations that you've used, what you've adopted from an accounting perspective, so that the audit team can come in, understand your positions, and be able to get comfortable with that, especially in an environment where there's not a lot of authoritative guidance. Getting your auditor comfortable with those accounting rules that you're applying is going to be critical. So this brings us to our tangible takeaway number 7, which is to start with a healthy accounting environment as early as possible. So to what Jeremy was talking about, looking at that organizational hygiene, what are the processes, procedures, systems that you have in place that you can close the books timely, that it's neat, organized, well documented. And next kind of branch here is that you're planning for the future needs. So even though you don't need an audit today, if you're going to need it in the future, that you have all of this ready for the audit team to come in and quickly get through your financial statements and be able to provide you with a clean opinion. And then lastly, being nimble enough in kind of the way you're constantly staying on top of the regulatory and reporting audit requirements for any changes in the regulations as kind of the SEC or other governing bodies catch up with this new space and more authoritative guidance comes out. You'll need to be able to adjust and apply that quickly and get your auditor up to speed.
So I think one thing to emphasize here, Heather, is even if you have never had a financial statement audit done and it wasn't necessarily something that you were thinking about or part of your roadmap, just because of the change that this environment goes through in methods of funding, in people expecting for more trust to sort of grow in this ecosystem, it's hard to anticipate when you actually will need the financial statement audit, but when you do, it can be painful if you haven't thought about it beforehand. We're helping a bunch of companies right now that are using a token offering to raise funds, and whether that's going through a Reg A procedure where it's required that you get your financial statements audited, or through a Reg D process. Even in Reg D, it's very much our expectation that best practices will be that you do get your financial statements audited. So, for most founders, this is not the first thing they think about in their roadmap, but it's fairly easy to get yourself set up properly today so that once you need it, things can just go a lot smoother.
Thank you, Andres. And now I want to hand it over to Heinrich to kind of talk you through, as an auditor, the types of questions we'll be asking and kind of what the audit will really entail for you.
Thank you, Heather and team. So once the fateful day arrives when you eventually will need an audit, what does that look like, and what are some of the questions and timelines that we typically see? As an overall statement, crypto and blockchain related company audits are similar to financial statement audits in some regard, but also different and have some very unique nuances to them, and best to understand those before jumping the gun and then getting ready for that audit. First of all, once you determine you'll need an audit, we would come in on the scoping and the planning side, and first of all, just try and understand the level of attestation that you and your stakeholders need. In the audit world, we can provide a review, or in some instances, we've provided opinions on a agreed upon procedures basis, or a full-blown audit. That would depend on you and the required needs. Next would be to understand the lay of the land. For us as auditors, it's really important to gain a vivid understanding of the company's operations and the company's use of blockchain. What do you do, and how does it align to the blockchain technology? We would also have to have those initial discussions on all accounting and auditing related issues. As you know, there's currently very little guidance over the accounting of crypto transactions, as well as audit standards related to crypto assets and those related transactions. So first of all, company management have to have a real clear sense of their accounting policies around a lot of these crypto related issues. Some of these issues that we've come across that you definitely have to think about before and get those accounting policies in place is, how do you account for your crypto assets that you hold? Are they classified as inventory on the balance sheet, or perhaps intangible assets, or what is your accounting policy on those? How do you value your crypto holdings? Jeremy earlier spoke about where you get your valuations from. There would have to be accounting policy and consistency around that. How do you account for crypto-specific transactions and issues, such as hard forks or various mining expenses? Again, these don't necessarily fall within a preset accounting standard guidance as is right now, but they have to be accounted for more on an analogous basis. And again, we're looking for consistency and documentation around those various transactions. A big issue that comes across in our audits is, how do you track your crypto exchange gains and losses by day, by week, by month? And again, having a clear audit trail over those transactions and accounting entries is critical. Then, if it's applicable, how did you account for your ICO proceeds? Again, no clear accounting guidance on this, and relates to a lot of estimates and judgment calls needed to make over those accounting issues. So, one to look out for. Another interesting example that we've come across is one of our clients granted ICO tokens as part of their ICO as well to staff members as a form of compensation or bonus to their staff members. So we asked the question, like, how did you account for that? Should that be accounted as cash bonus payments similarly, or is it more similar to a stock-based compensation transaction in the GAAP world? So a lot to take into consideration here. And not just for the accountant and management, there's a lot to consider before jumping into an audit on the auditor side. Once you have those initial conversations with your auditor, you have to get ahead of certain audit issues. As I mentioned, there's very little auditing guidance over blockchain and companies as well right now. So what level of assurance is your auditor willing to place on the blockchain and related cryptographic technology? That's a typical big question that most of our customers asked. And what is your process for testing digital assets held in cold storage, for example? So just trying to highlight some of the common issues that occur with many of our audits. So this process of just scoping and planning would be a minimum of 3 to 6 weeks. So hopefully that helps you in terms of understanding the timing of that section. Once fieldwork comes around, again, very similar to a typical financial statement audit, but also different in the sense that a lot more heavy reliance on IT controls and user access controls going in and from the blockchain. So that's something to keep in mind as you look ahead through the audit process. On the back end, when you get to the reporting stage of the audit, drafting financial statements and ensuring that those various disclosures tie in with the US GAAP requirements. There's a lot of crypto-specific terminologies and accounting policies here that have to be laid into those accounting and financial statement disclosures. So that takes a lot of back and forth between the auditor and management to ensure that those disclosures are complete. And as Jeremy has mentioned, the tax provision and tax disclosures are extremely tricky and timely as well. So just a forewarning there that the back end of the audit could be timely as well, and just be aware of that. So I think our tangible takeaway here is that preparation is key, especially when you're dealing with deadlines to provide audited financials. I would recommend getting those auditors in line way ahead of time and having those conversations and asking those difficult questions that will inevitably pop up as you go through the process.
Thanks, Heinrich. Very much appreciated. We're running short on time here, so we will go a little bit faster through some of our last slides. But I do want to give you guys some crypto audit tips and tricks now that we know a little bit more about an audit. And the first thing is to limit the tokens and native currencies that you have on small blockchains. The last thing an auditor wants to worry about during an audit is a 51% attack. I can only imagine what the auditors of Ethereum that had Ethereum Classic on their books late last year were thinking. The potential for a Genesis attack where the whole blockchain is rewritten. Could cause serious issues. If you ever have questions as far as how strong your blockchain is, you can always go on crypto51.app to check that out. Next is using HD wallets. It's going to save everyone a whole lot of time. Think if you had 100 different addresses, but they were derived from a single HD wallet, we're only going to have to test that master XPub, that single wallet, or that single derivation. Whereas if you had 100 different individually derived wallets, we're going to have to test probably like between 20 and 30 of them to get comfort over the balance in those accounts. Next is making sure that you maintain your records for at least 7 years. I mean, that's the tax requirement, but you also want to make sure that you keep all your private keys for any wallets or exchanges used during the history of your company, really, because it might be 2019 now, but you might want a 2017 audit. And in order to prove the ownership of those assets held at 2017, we're going to need those keys. Next is ensuring that you have the proper reporting capabilities. You want to make sure that your reports have transaction hashes, IDs, timestamps, cost basis, etc. So you might be feeling a little bit not ready, but that's okay. I mean, we all have to start somewhere. And so we have a few ideas that can help jumpstart you. I mean, one of the things that is really cool about the crypto accounting solutions that we mentioned is that oftentimes you can actually go back in time. Since blockchains allow you to pull historical data, you can simply put in your public address into the crypto accounting solution, and it can pull all the historical data related to your wallets, which is pretty great. But you're still going to need your proper documents and processes in place. But most importantly, you're going to need the right people on your team. This could be a homegrown expert. It could be someone from Marmanino. It could be Satoshi, down the street. The main takeaway here is that the accounting world has drastically changed when crypto has been introduced. UTXOs, key management, and a lack of accounting guidance has really made for an ambiguous environment. What we've seen is that the projects with the greatest percentage of success are those that are passionate about the space, not only to solve the technical problems, but that passion can also help you solve the operational problems that accounting and finance often falls into. So that takes us actually to our last polling question. And it's surrounding a topic that there's differing guidance depending on who you talk to. And that's how you value your crypto assets on a periodic basis. Do you hold at cost or do you market to market?
And I realize we're running 1 or 2 minutes over time here, so appreciate you guys sticking in, and apologies for the late start. It was very much due to unforeseen circumstances. All right, well, it looks like we've got a good amount of people who have voted, so I suggest we close the poll. And this question was really just curiosity, as well as a lot of people asking us what is the right way of doing it and what are other people doing. And so we thought we'd share with you what everyone else is doing. So it seems like mark to market is the most popular response right now, fairly closely followed though by a lot of people still holding at cost and subjecting to potential impairment. So to Jeremy's point, there's just a lack of guidelines here, and the regulators really catching up. So it's not necessarily to tell you one way or the other is right or wrong. It's more what is everyone else doing. So in closing, appreciate you guys dialing in today. A lot of what we talked about today will be found on our website through some white papers that either are live or will go live in the next 24 hours. So hopefully, if you want to dig in more, you can look there. Definitely talk to the teams. And then we had a bunch of folks who asked questions. We have not forgotten about you. Unfortunately, due to the time constraint, we'll have to follow up in person with you on those questions. But I do thank you for asking them. Again, our apologies for starting a little bit late and ending a little bit late. And again, a big shout out to all the different teams that we worked with in evaluating the different accounting solutions out there, and appreciate all the hard work that all of you are putting into this every day. All right, thanks so much. With that, we'll close up our webinar.